of course, on 1 hour class meeting, and we are not going to cover all aspects of liabilities, but I select the content on which I put focus based on your assignment and the question in the final exam also. So I try to make my class meeting with you as useful as possible for you in terms of marks and evaluation. So again, as you know, there is an assignment number 5, but that one is optional, not compulsory. So you can do it if you like it will replace the worst mark you got on the Connect assignment if you do it, and if it is better, of course. In terms of liability, I'm going to focus on the most maybe difficult aspect, okay? Many aspects are relatively easy. You can understand them by reading the textbook and self-study is enough. But some aspects are a little bit complex. So let me take advantage of this class meeting to practice specific aspect and liability, especially the present value calculation. So whenever it is very means frequent, very common when it comes to liability that you need this technique, because the company, when they recognize a liability, let's say purchase of PPE, you debit equipment and then you credit if it is a long-term liability, then it has to be accounted for not at the future value, at the present value. Okay, so long-term liabilities so have to be accounted for at their present value. For example, let's make an example illustration. So let's say company ABC purchased an equipment for the purchase equipment with this payment schedule. Okay, and here we can imagine many kind of payment schedule, and we are going to imagine scenarios that are helpful for you to get to familiarize yourself with the calculation, present value calculation. So of course, if they say scenario 1, for example, for cash, okay, we'll say the price, listed price. Now the word listed becomes crucial. The listed price equal, or let's say $300,000. Okay, so this is the listed price for that equipment, $300,000. Okay, so if they say purchased for cash, that is obvious, easy. So debit, equipment, credit, notes payable, for example, no, sorry, cash for the listed price. That's easy, okay, obvious. And by the way, if they say it was purchased for account, so for account means credit. It cannot be, it cannot mean cash. Whenever there is a purchase or a sale which is made for account, that systematically it has to be understood as a sale or purchase for credit, by the way. Okay, so this is scenario one. Scenario two, let's presume that it was agreed to pay this way. Let's say 20% cash, 40% within 6 months, and the balance within 2 years. And here we start to need the present value. The balance within 2 years. So if they say the balance within 2 years, we need to have a discount rate. So within 2 years, if you pay within 2 years, then we need a discount rate. The discount rate, it could be either given by the provider itself, the vendor, or if not, you can make your simulation and ask your bank, what if, which if it is implicit, what if I get a loan of 40%, the remaining 40%, what would be the interest rate you're going to charge? Did we start recording? Yeah, we did. So then we need, whenever it is a long-term liability, we need a discount rate to calculate the present value. Discount rate equal, for example, let's say 3% or let's say 4%. Okay. So the rule is short-term liability does not require any present value calculation. Short-term liability is accounted for at the face value. So no PV calculation needed. Whenever you have a liability, an account payable for less than 12 months, we presume the underlying assumption here is that the dollar did not lose value in the meantime, which means $1 today is equivalent to $1 within 6 months by assumption, even if it is not real, not correct in reality, considering the inflation and considering many considerations, but still for accounting purpose, we always, this is what we call the monetary unit assumption. The monetary unit assumption will make this assumption then $1 on January 1st is equivalent to $1 on December 31st. In a 12 months period, there is no need to present value calculation. So we presume that the $1,000 today is equivalent to $1,000 within 10 months. So that is for short term. However, long-term liability need to be accounted for at its fair value. I think we did it already. We say it. Okay. So we already said that the rule is the long-term liability have to be accounted for at their present value, which means what I should not do, of course, I cannot credit long-term liability for. So here we have to make our journal entry, debit, equipment. Sorry. Debit equipment for an X amount, I don't know yet. I should not use the listed price now. The value, the book value of the equipment of the PPE purchase should not be the listed price. It should be the present value of the consideration given. The rule is a PPE is accounted for at the present value of the consideration given. This is it worth to be written here. PPE should the PPE should be accounted for at the PV of the given consideration, which means the present value of what you gave up to get that equipment. But what we have gave up, we have gave up a percentage of it cash. The present value is cash is the same. Present value of $10,000 is $10,000, so that is the equivalent. So we are going to credit cash for the present value of for 20% times the listed amount, $300,000. Credit the short-term liability for its present value, which is without, which is, it means the face value is considered as present value. Accounts payable, that is the short-term portion of the loan, and that is 40% multiplied by $300,000, the listed price. And then we have to credit long-term note payable. And here we have to make a calculation. The present value of the balance. Okay. And then when we get this amount, then the present value of the equipment would be the addition of the three amounts, the three present value. The present value of $60,000 cash is $60,000. The present value of $100,000 within 6 months is presumed to be $120. Now, what is the present value of that future amount? This is what you're going to and this is the technique. So we first have to collect the data. First of all, what is the face value of that long term to compute the PV of the long-term note payable? First of all, you see the dilemma here. You see the problem. Okay, the problem is that a portion of this amount of the $300,000, 40% of it is going to be paid within 2 years. It does not make sense that within 2 years we simply calculate the face value, which is the future amount. It does not make sense because after 2 years, the future amount will be worth an amount which is much different than today's. So that's why the calculation of the present value is needed. To commit present value note payable, so what we need, the face value, and that one is, so 30%, $300,000 multiplied by, do not hesitate to interrupt me if you need more explanation, 1 minus the 20% cash and minus the 40% short term. So that is $120,000. This is the face value. And the question is, how much is it worth today? $120,000 within N, in this case, 2 years. So how much is it worth today? That is what we mean by the present value. And for this, we simply use the present value formula, which is available on Excel. So just familiarize yourself about how to use it. So I go to formula, and then I can either search it or go to the financial calculation. You can calculate it with your financial calculator also if you have one. But anyway, for your exam, for example, of course, you have access to your Excel file and to your calculator. You can calculate it. So financial, and then I look for PV, present value. Next, and then there is a form that will show up. All I have to do is just to fill out that form. The form asks what is the rate, and of course here we presume a rate related to the period. So here the rate is even here the rate is, where is it, the discount rate. We said 4%. And then what is the number n, the number of period? And this is a present value for how much, how many periods? So in order to calculate the present value, you need the discount rate and you need n, the number of period. In this case, how much is n? How many period do we have?
2.
2 years, because the period is related to the rate. Okay, the discount rate is yearly and it is going to be paid within 2 years. So if the discount rate was quarterly, so then 2 years means 8 periods, right? For period for each year. So you have to coordinate the interest rate with the number of period. By default, an interest rate given without any indication of period is by default yearly. Never ask for which period if it is not given. If it is not given, by default, an interest rate is yearly. So if we say that the discount rate is 4%, that simply means 4% per year. If it was intended to be per month, at that time they will tell you 0.5% per month. But if they say if the rate is given without any indication of period systematically, it should be interpreted as yearly rate. So because we have a yearly rate of 4% and because the period of 2 years, so n equal 2. Payment. Are there any payment in between? According to this scenario, there is no payment in between. From now to 2 years, the full amount is going to be paid at once within 2 years. So which means payment is equal to 0. Okay, and we are going to change scenarios to see how this parameter is used. So for now, we know that in the meantime, so what we mean by payment here means between today and the future date, the day of the due date or the deadline, are there going to be installment payment? So the answer for this scenario is no. So 0. And the future value, what would be the future value in this case?
Would it be 120,000?
Exactly. So we are asking Excel to calculate for us what would be today's equivalent amount of an amount for which we know means the rate, the payment, and of course the amount, the future value or the future amount is 120. And that's it. Insert, and we will get the information. It will be negative, so just make it add a minus sign so that you get the number first. So this is the present value, simply 110,000. So 120,000 within 2 years is worth today 110,000. This is the number you use to make your journal entry. So this, in that case, the journal entry would be so cash is the same, 60. Account payable short term with no PV calculation, and the present value of the balance is what we have just calculated, and that will be the value, the book value of your equipment also. This plus, sorry, plus this plus this. Okay. So this is one scenario of present value. So the way this scenario, we have a single sum, a single future sum that we need to bring to the present. Any question about this scenario, the simplest one, before we make it more complex? Okay. Now, let's go to scenario 3, and we are going to presume this. Let me copy this. Scenario 3, for example, we say we pay, okay, let's say 10% cash, 15% within 6 months, and the balance we are going to pay or instead let's do it in a different way. Okay, instead of percentage, we are going to paid $50,000. This should be dollar amount now, or let's say 40,000 now immediately, 90,000 within 6 months, and also the balance paid through so let's say $30,000 each year. Okay, the balance is, let's say, for yearly payment of $30,000 each. Okay, discount rate. So I remove the 2 years. Discount rate is 4%. Same discount rate. Okay, so we pay 40,000 cash, 90,000 within 6 months, and their balance is going to be paid over 4 yearly payment of 30,000 each. Then we also have to calculate the present value in this case for the long-term note. So to compute the PV of the, we say 4, right? 4 installment. So when it is the same amount paid every year on a regular basis, same amount and same periodicity, same period. So not 40,000 now, the other 40,000 after 2 years, the other 40,000 after 5 years. That is not an installment. In order for an installment to be qualified as an installment and to use the present value formula for an installment, it has to be exactly the same amount, a series of payment for the same amount and the same periodicity. Also, if it is the same amount without maintaining the same periodicity, that is not an installment. Paying 40,000 after 6 months, another 40,000 after 18 months, another 40,000 after 3 years, that is not an installment. In order for a series of payment to be qualified as an installment, it has to be exactly same amount and exactly same periodicity. So to compute the PV of the 4 installment, we use exactly the same formula. So now we have the payment. The information Excel will need to make the formula is this. We need the payment, and we say 4,000, 30,000. We need N, the number of period, how much? 4 payment. Okay, and the discount rate R, which is the same discount rate, 4%. And is there any final payment? In this case, no. Future payment, final payment? No, we only go to pay 40,000 and that's it. So then I apply the PV, the same formula. Go to formulas, and I can also just search it directly here instead of going to PV, and then I simply will fill out the form. Rate 4%, number of payment 4, payment amount 30,000, future value how much? What should I put here? Future value. In addition to these installments, are you going to pay a lump sum at the end? The answer is no. So it should be 0. We are not going. We only are going to pay 30,000 every year. That's it. Okay. And here type. This is optional. As you can see, I did not use it last time. Type for Excel simply means are the payments done at the beginning of the period or at the end of the period. Are you going to pay immediately 30,000 and then another 30,000 within 1 year? No, the answer is no. What are going to pay immediately is 60,000. What we are going to pay, or no matter the amount which is given. But if by default you keep it empty, 0, if the payment is at the end of the period, and whenever it is about interest, by default the formula is at the end of the period. When do you use at the beginning of the period? If it was a rent, if you make a rent, if you make you are renting something, an equipment or a building, and you need to calculate the present value of your rent, because the rents are paid at the beginning of the period. You take the building today, you pay before, all right, the day you start the rent contract. So then you have to put 1 in this box here, which means consider that the payment is done at the beginning of the period. By default, if you don't put anything, it is presumed to be at the end of the period. So we're going to keep it without indication. So that's it. So, and we have the amount here minus. So paying $30,000 4 times each year is the equivalent of paying today $108,000, which means your journal entry would be then, so debit note payable for that present value, $108,000, debit accounts payable for what is given here, 90,000, and credit cash for 40,000, and debit the equipment for the total of the 3 amounts. Okay. So this is another scenario of payment. So let's do another one, for example, where what can we do as a different scenario? Let's say scenario 4. Nothing is paid cash here in this scenario 4. Paid nothing at short term, paid by through 4 yearly payments of, let's say, $35,000, and a lump and a single sum, and let's say $100,000, within, okay, on the 5th year, okay, after 5 years, okay. We're going to pay $35,000 and then a single amount of $1,000 after 5 years. So here, how to calculate the present value, and we maintain the discount rate as it is. So what do you suggest? What do you suggest to make this calculation? I don't have cash. I only have debit equipment and credit, notes payable, long term, on an X amount, which is the present value of all of this. What do you suggest? How to make this calculation? So this is what present value calculation is all about. The formula is there. It is how to use it smartly and correctly.
Would you have to do it for each piece and then add it
Very
together?
good. Excellent. We cannot, the way the formula is designed on Excel will not allow to calculate this at once in one single formula, because these are two separate patterns of payment. They cannot be combined together in one formula. The first pattern is for installment, for equal yearly payment of $35,000. That is one pattern. And the other pattern is a single payment within 5 years. So, but if the single payment was within 4 years with the 35,000, we can use the same formula. But in this case, the fifth payment, or the fifth payment will be done within. So we have to use two present value calculation. Present value to calculate this, the installment, and a present value calculation to calculate the single payment. Okay. PV to compute the installment, and then after that PV to compute the single payment. Okay, and then if we call this P1, and if we call this P2, so what you are looking for is simply P1 plus P2. So the PV of the note payable will be equal to P1 simply plus P2, which means the present value of the 4 payment of $35,000 plus the present value of a single payment of $100,000 within 5 years. And now you know how to proceed. So for the first one, payment is equal to 35,000. I'm preparing the data so that Excel can make the calculation. N equal to 4 for payment, and the rate and R equal to the discount rate. Some will call it I also. Where is it? 4%. And I calculate the PV. And now it is all about how to fill that form. So rate 4%, number 4, payment 35 each, 35,000 each, and future value 0. Again, if the $100,000 is going to be paid at the same time as the last 35,000, then we can use a single formula and put the 100,000 here. But because the 100,000 is going to be paid 1 year later, so we cannot combine it. So we have to put 0 here so that we can, and I add the minus sign. Present value of $35,000 paid 4 times is then 172,000. I don't know where the euro come from. Each time it comes with a euro sign. And then for the other one, so for the present value, then I don't have payment, but I have the future value, which is 100,000. Payment is 0, and the same N and the same R. So PV rate 4%, number 5, right? 5 years, within 5 years. Payment 0, and the future value is 100,000. Insert. Okay. Paying $100,000 within 5 years is the equivalent of paying immediately $82,000. And then we make our journal entry, equipment, and long-term notes payable for that amount, which means, of course, 127 plus 82. Okay. Any question about present value calculation so far? Okay. Of course, in your assignment on Connect, there is another option. I don't need to waste time with that other option, which is use the present value tables. There are predetermined present value tables where you can use also to make this calculation, but you are not obliged to do it. Now we have Excel available for everybody. So I won't spend time explaining you how to use the PV tables. You can just make your reading. The tables should be available somewhere in your textbook, maybe at the end of the textbook, or at the end of the chapter about long-term liability. There are the PV tables that could be used to which chapter is it? 9, right? Could be used where you simply multiply the amount for which you need to calculate the present value by a number that comes from a table given for this use. I don't see it here, but it should be available maybe on Connect or. Okay. So anyway, so there is no need to waste time on that. So just as you have Excel, you have access to Excel, whether for your assignment or for Connect or for the real life also, if you need to calculate the present value of, if you have an option in your own real life, if you have a 2 option, let's say, I don't know, to buy the car or to rent the car, you can make this kind of calculation, and the one which has the lowest present value is the better option for you if you are to pay, of course. If you are to pay, then to compare 2 options that are offered to you, calculate the present value for both options, and the one which is if you have to pay, of course, which gives the lowest present value is the most beneficial for you. Using this same technique of present value, we are going to learn how to count for bonds payable. Okay, accounting for bonds payable. Okay, so this is the second topic, right? Subtopic. So first topic is present value calculation, and then so this will be 2, and 1 was PV calculation. What are bonds? So if a company needs money to finance a project, for example, what option do they have? We need to buy a building, 3 million. What option does a company have?
A loan or share issuance?
Issuing shares, contracting a loan from a bank. But if for some reason these two options either are considered as very expensive, okay, you may ask how come issuing shares is expensive? Yes, share capital has a cost also. Anyway, we will see it within the shareholder equity section. Or there is no bank available or willing to provide you with a bank loan. One of the options, if you are a publicly traded company, of course, if you are a publicly traded company where your shares are traded in the public market, then you can issue bonds. Okay, issuance of bonds, and which simply means that amount of 3 million, I'm going to split it on shares of $1,000 each, so that everybody, the large public, can buy those bonds, of course, with a maturity day, a due day to reimburse the loan, the bonds loan. And of course, those bonds will generate interest in the meantime for the bondholder. The bondholder will receive interest and the company will have to pay bonds. So this is the mechanism of getting a loan through bonds. So this is, and in terms of balance sheet, it will appear as bonds payable on your statement of financial position. So there is some complex calculation which relies on the present value calculation about how to account for these bonds. So let's make scenario 1. So ABC issued, let's say 3,000 bonds of $1,000 each. As a par value. Par value each. Par value, which means not the market value, the par value, the face value of the bond, which means the value on the document, on the paper. Because as soon as the bonds are traded on the market, what will determine the price of the bond is demand and supply. Actually, the market will determine the market price, the effective price. But the company will simply establish a par value. I'm going it means to issue 3,000 bonds at a par value of 1,000. Maybe the market is willing to pay only $900 for one bond. They may be willing to pay $1,100. But at the end of the day, I will pay back at the maturity day $1,000 per bond. This is how it works. Means there is a par value, which is the face value, which is used to calculate the total amount that is going to be reimbursed after 5 years or 7 years or 10 years. That is the usefulness of the par value. And it's also used to calculate the interest to be paid to bondholders. But that is not the effective price on the market. And let's go consider these. We need some data, of course. Issuance of 3,000 bonds of $1,000 par value each at a coupon rate of, which is also called the stated rate, the rate of interest let's say 4%. Okay? Which means the company is going to pay for every bondholder 4% per year for those bonds. 4% of what? Of $1,000 per bond, of course. And then at the day the issuance was, this is the coupon rate, also called the stated rate. So called the stated rate. But it should be compared to the effective interest rate. And let's presume that the effective interest rate at that day in the market was, let's say, 5%. Also called the yield rate or the market rate also. What is the market? Yield, there's no A here. Yield rate. What is the market willing to receive as, or what would be the satisfactory rate that the investors in the market will accept for a similar bond presenting the similar credit risk? This is what is the yield rate. Okay, any question about these concepts before we start the counting, processing, and the computation? So there is some computation to prepare, and then after that, the counting, process, and the journal entry. Any question about these concepts? So this is the number of bonds. $1,000 is the par value or the face value, also called face value. Again, what is the face value used for? Two uses. The face value in the market, it is meaningless. It have no value in the market. For investors, investors are not going to pay $1,000. That is just a face value or a par value or value on the paper, if you like, because the value of the bond will be determined by how attractive your bond for the market. Okay, so if it has not a value for the market, then what is the usefulness of this par value?
Just for calculations?
Calculation of what? Of the interest that is going to be paid to the holders. We are going to pay for the holder at every payment period $1,000 times 4%. That is the basis of calculation of the interest that is going to be paid. And there is another need also in addition to this. That is, yeah. $1,000 of par value is the amount
That you'll get at the end of the term?
Very good. At the maturity day, no matter how much you collected today at the issuance day, at the maturity day, you're going to pay $1,000 per bond. Whether you collect today $900 or $1,100 at the end of so that is the usefulness of the par value. Two uses. First of all, that is the basis for the calculation of the payable interest. And then the other use is that is the amount that is going to be paid back at the maturity date. The stated rate, 4%. What is the use of this information? The stated rate. This is again a rate on the paper. Rate on papers, not on the market. So simply to calculate the amount of interest that is going to be paid, the cash amount of interest that is going to be paid to the bondholders. However, and this is where the complexity comes from. So it would be easy, it would be simple for accounting purpose if the interest expense was equal to the cash amount of the expense. Then it would be very easy. If the interest expense from accounting perspective was equal to the cash amount of the interest paid, That would make the life very easy. However, unfortunately, or maybe fortunately, that is not the case. For accounting perspective, to account for the interest expense, you have to use, so first of all, to calculate the cash amount of interest. Okay, let's say it is yearly, of once a year. So how to do it? Simply face value times coupon rate. Of course, time is the number of bonds, of course. But to account for it, we have to make a different calculation, another calculation. The interest expense for accounting purpose is not equal to the cash amount of the interest. Okay, and here we rely on an accounting principle which is called substance over form, the substance over form principle, which means the $1,000 times 4%, that is the form, that is on the paper, that is on the documentation, not in reality. Accountant is here to reflect, to account for the economic substance. The real cost of the expense for this of your bonds is not what is on the paper. It is what the market determined. It should be calculated using the yield rate, the market, the effective rate, not the coupon rate. So interest expense is equal to the yield rate multiplied by the yield rate, not multiplied by the face value of the bond. No, multiplied by the net book value of the bond. Net value, or the carrying value is better. The carrying value of the bonds. And we're going to see how it works. So okay, let's go step by step. Let's start with to account for the issuance, the day you issue the bonds. To account for the issuance of the bonds. Okay, you're going to debit, of course, what? The day the bonds were issued, debit cash, of course, and credit what? Bonds payable, a long-term liability which is called bonds payable. For an X amount. Okay, what is that X amount? Okay, let's go. It is a little bit complex, so we're going step by step. And please do not hesitate to interrupt me and to ask questions. The day of the issuance, this is what I'm going to do, to record. Debit cash, credit bonds payable for an X amount. What is that X amount? And now we use that PV learning. It is simply equal to the PV of all the future amount that are going to be paid for this loan. It is simply means, it is the PV of all future payments on this on the bond loan. And when we say all the future payment, what does it include? All the future payment means what? Payment of what?
All the interest plus the
Interest
final amount?
plus the final amount. That's it. So we are going to pay on a regular basis, in yearly basis, an amount of interest. And also we are going to pay a single sum after n. We did not indicate here the n. Let's say, let's complete the data here. Issued 3,000 bonds. And also let's here, for example, over, let's say, 5, okay, 5 yearly payments, and maturity day equals within 5 years. Okay. Okay. So all future payment, which means including what? Interest, or the cash interest. Cash interest. We calculate the present value of what we are going to pay in reality, which is the cash amount of the interest, not the interest expense. Interest expense is for accrual-based accounting, not for cash. Okay, so here what we need to calculate is the present value of the cash amount of interest. And now we know that the cash amount of interest is not equal to the interest expense. So we have to calculate the present value of what we are going to pay as cash amount. So including the cash interest payment, as well as the reimbursement of the capital reimbursement at the maturity date. Okay. So, and now we know how to make this calculation. PV, and now because of in this case, the payment that will happen at the maturity day will coincide with will be synchronized with the last interest payment. We pay the interest at the end of every year, and at that day, so the last payment will be the same day of the reimbursement. So then, what does it mean here? I don't need two separate formula of present value. It can be combined at once, because if the last payment is done at the same time of the last interest payment, if the principal repayment day is the same as the last interest payment, so one single formula is enough. Not like the example we did before, where the last payment will happen after 5 years. The single sum will be paid after 5 years, while the last payment will be done after 4 years. So we can simply, and that present value is the issuance price. Issuance price is equal to simply the present value. Let me first prepare all the data before we make the formula, so that we don't navigate on the. So here, future value is equal to, we said, 3,000 bonds times $1,000 each. Okay, this is the face value, or the future value. Coupon rate R is equal, or let's call it coupon, equal, we said 4%, and yield rate, or effective, let's change effective interest rate, which is called I usually. In this case is 5%, and N, equal 5 years. I have all I need, so that present value PV formula, PV rate. Okay, What do you believe the rate should be added here? What rate should I use? We have two, the coupon rate and the yield rate.
Coupon value?
No. For this calculation, Excel will not even recognize the yield rate, the coupon rate. The coupon rate is because the rate we have to put here is the rate that will bring the future payment to the present. That rate is determined by the market, not by you as a company. The discount rate, which is dedicated to bring a future amount to the present, that is not determined by the company. That is determined by the market, the economic reality, the substance. So it could not be the coupon rate, because the coupon rate is a political decision, managerial decision. Okay, just it does not have an economic value in the market. So apart from the fact that it is simply for mathematical calculation of the interest, the cash amount of interest. So what you have to put here is the discount rate, the yield rate, the market rate, which is in this case 5%. The number of payment is 5, and the payment here we are going to now I need the cash amount of payment. How much are you going to pay each time? There where you use the stated rate, because in reality, and this is also another economic reality, in terms of cash amount, you're going to pay $1,000 times 4%. Okay, so payment is 4%, the coupon rate times the $1,000, times, of course, times the face value, times $1,000 times 3,000, and the future value is this 3 million. This is what I'm going to reimburse at the maturity day. Insert, and I add the minus sign at the beginning. So 2 million. Okay. Today it is worth 2,870,000. That is the issuance price. We call this, and when the issuance price is lower than the future value, we call this an issuance at discount. If the opposite, if it's the opposite, it could be higher, then it would be issuance at premium. So in this case, it is an issuance at discount. What is the reason? What is the rationale of this? Look at this. According to the market, if you invest on the market as an investor, as a bondholder, you, not the company side, from the side of the bondholder, as an investor, if they invest on the market is going to generate 5% interest income for them. Okay, now I am an investor talking to you, the company. Look, if I invest in the market will provide me with a 5% revenue, interest income. But you say you are going to pay me 4% only. What would make us, or what would make me invest in your bonds, while if I invest on the market, I will gather 5% of interest? The answer for this, okay, but if you invest in our bonds, you are not going to pay 3 million. We are going to reimburse you 3 million, but you will only going to pay 2,800,000 only, which means we are going to provide you with a discount. Just give us 2,800,000 today, but we are going to reimburse me 3 million at the maturity day. And now the investment becomes attractive. Now it makes sense for me to sacrifice a 5% rate on the market in favor of a 4% rate from you, considering that today I'm not going to pay the full amount of the face value. I'm just going to pay 2,800,000, while at the maturity day I'm going to collect 3 million. So this is the market explanation why the issuance amount here is lower than the face value. Now, any question so far? Now I can make our journal entry. So journal entry, debit, cash, credit, bonds payable for that amount which is calculated. How about now the cash payment, the cash interest payment? Each time I pay the interest, how is the accounting for? This is to account for the bonds issuance. Now, what should I do to account for the interest payment? Here we have a dilemma. We have a small problem here. The problem is that from cash perspective, what I'm going to pay as cash on the credit side, as we said, the cash is simply clearly the face value multiplied by this coupon rate. This is what I'm going to pay cash. So the payment, so at every payment day, this is what at the first, not every, because this will change, okay? To account for the interest payment, for the first interest payment, okay? To make it clear, because it will change every time. The cash amount will not change, but the interest expense will change. Cash equal 3 million times what? How much cash am I going to pay at the first interest period after 1 year? 3 million times
The coupon rate?
the coupon rate. This is my commitment to pay 3 million times the coupon rate, 4%. Okay, $120,000. However, according to the accounting rules and the accounting principle, what I should recognize as interest expense is not that amount. Interest expense, for accounting perspective, that it is not the same amount. In fact, the interest expense should be calculated using the market rate as per the economic substance over the form, because the coupon rate is considered as a form, a legal form of the commitment. But the economic reality is that the cost of this, as you can see, do you see the reasoning here, the rationale here? You cannot say that this the cost from account perspective is just $120,000. No, do not forget that you have collected today 2,870,000 while you are going to reimburse 3 million. That is part of the cost also. That difference, that discount rate is part of the cost. You cannot ignore it as if your cost for account perspective was only the $120,000 cash amount you pay only. So that's why the way we calculate the interest expense for accounting perspective should be using the market rate, 5%, multiplied by what? We said, is equal to the effective rate multiplied by the carrying value of the bonds, which means the net book value of the bonds. Today, first payment, what is the carrying value of the bonds on the books? On our books, what is the carrying value of the bond? Is it the 3 million? 3 million is the maturity day, the face value. In our books, these bonds are accounted for at which amount? Yeah.
The 2 million?
The 2,870,000, the issuance price. At the first day, that is the account value. So we have to multiply the interest. No, it doesn't balance. How am I going to balance the journal entry? Debit interest expense as per the accounting rules, $143,000. Credit cash as per what am I going to pay cash effectively, $120,000. Then the balance will go, actually, it will go on the credit side of the bonds payable. I'm going to credit bonds payable for that balance. And that balance, that difference is the amortization of the discount, simply. This minus this is the amortization of discount, which means The effective cost for you as a company, the issuer company, is what you're going to pay as cash interest plus a portion of that discount. That discount, because you are going to we can calculate here the full amount of the discount is equal to the difference between the 3 million that I'm going to reimburse at the maturity day minus what we have collected today. That $129,000 of discount, that is part of your cost, and you have to amortize it and bear a part of it, a portion of it every year. So this is how. And when you do this, what happens to my bonds payable account? Look at the carrying value of my account. Sorry, bonds payable. If I make the T account of the bonds payable, look at what happens. So we have at the issuance day credited the bonds payable for 2 million, and now at the first interest payment, we credit $23,000. Okay, which means now the carrying value is increasing progressively. The carrying value is not the same. So next time, to account for the second interest payment, we're going to do the same thing in terms of cash, nothing changed. Same, always, $120,000. But for accounting perspective, I have to debit interest expense for what? The coupon, not the coupon, but the yield rate, the effective rate, 5%, multiplied by the carrying value. But the carrying value has moved now. It is no longer the issuance price. The carrying value is now, as per the T account, if you like, is the issuance price plus the first amortization of the discount we made last year, yeah. So this is now the interest expense is 144. The difference is bonds payable, and that is the difference. And that will go here. It will increase our second, okay, interest payment will increase our carrying value, and the new carrying value is going to be used to calculate interest expense. According to you now, if we continue, even if we don't make the calculation, if we continue second, third, fourth, what do you expect the book value at the day of the reimbursement? Imagine you continue this way. What do you expect the final book value will be at the day of the reimbursement? It will simply be equal to the
3 million.
exactly to the 3 million, to the par value. So that when you make your journal entry, you are going to simply debit bonds payable 3 million, credit cash 3 million, and that's it. It will disappear. The bonds payable at the day of the maturity will disappear because the bonds payable is going to increase progressively from the issuance price until at the maturity day it goes it. So, and usually to manage all of this, we do not do it like this year per year. We simply prepare what we call an amortization schedule, which is done this way, so that we don't, so that we know what will be the interest for next year's. We don't have to make this calculation each time. Let's make the amortization schedule. Of the discount, okay, and this is, of course, in this case it was a discount. Okay, now of course if we make a small change here, let's say our coupon rate, we will keep it as it is, 5%, but presume that the market only offers 3%. look at what will happen. What do you expect to happen? If I am paying 4% interest rate, while in the market, the market only offer 3%. As an investor, from my perspective, if I invest on the market, I will get 3%. If I invest in your bonds, you will pay me 4%. What do you expect the issuance price to be compared to the maturity price?
It's going to be higher.
Higher than the 3 million. Okay, if we do it 3%, look at what happens. Now the issuance price becomes 1 million, and that is not a discount. Now it becomes a premium. A premium, which means you as an investor, because the market only offers 3%, while we are going to offer you 4% more than the market, then you have to pay as a premium, which means you pay as more than the 3 million we are going to reimburse at the maturity date. And if it was a premium, the change will happen at the end. It means the process is the same, the rule is the same, except that at that time, the bonds, you will debit the bonds payable each time, because at that time, the cash amount of interest will be lower than the interest expense. And then you will have to debit the bonds payable, not credit, which means you start with an amount which is higher than 3 million, and then it will debit, which means you decrease the bonds payable progressively until at the end of the maturity day, you get exactly to the same. So let's go back to our initial scenario with discount. Okay, so to prepare the amortization schedule, what do I need? I need the dates. I need the cash interest, a column for the cash interest. I need the column for the interest expense. I need the column for amortization of the discount. Discount amortization. I need the column for the unamortized discount. And I need the column for the carrying value. So carrying value. Okay. So at the day of the issuance, there is no cash at the day of the issuance, of course. At the day of the issuance, the carrying value is equal to the 3 million, means the issuance date, which means 3 million minus the discount, or 3. Okay, let's start with the unamortized discount. At the day of the issuance, we have a discount of unamortized debt of this 129,000. Where is it? Right, $129,000. Okay, and the carrying value is always equal to the par value, the 3 million, minus the unamortized discount. I want to fix this address minus the unamortized discount, which is the issuance price, 2,160,000. And now, first payment, second interest payment, third interest payment, first. This is the amortization schedule until the fifth interest payment. Okay. Now, how about the cash amount of interest? Is it going to change? Is the cash amount of interest going to change?
No.
No. And it will always be equal to what? Always equal to the par value. It will never change. Par value, 3 million. Multiplied by the coupon rate. Multiplied by the coupon. And dollar here also. Right? and this will never change. We will keep paying 120 every time, 5 times, right? However, interest expense will change. First year interest expense is equal to the carrying value of last year, of course, multiplied by the coupon rate, sorry, the yield rate, 5%. Yield rate. The discount amortization is simply the difference between both. So the unamortized discount at the beginning was $129,000, and it will keep being amortized progressively. And each time it will be decreased by the difference between the cash interest and the interest expense, the cash amount of interest and the interest expense. This minus this. So I have $23,000 of amortization. After this first amortization, the unamortized amount will go down from 129,000 to 129 minus 23. And then we keep always the same formula for the carrying value. The carrying value, it is always equal to the par value minus the unamortized discount. And we keep going this way for 5 years until at the end of the day, as you can see, on the maturity day with the 5th payment, the carrying value, we will amortize all of the discount, 0 discount unamortized at that point. And as you can see, the carrying value will increase progressively until at the maturity day, it comes to 3 million. And this is what you need for your amortization. So as you can see, first year, you remember the numbers? Debit, interest expense, and the 43, credit, and the bonds payable for 23,000. That is the number here. That is the 23,000 in amortization. And 24,000, this is the amortization of the second year. And if you keep going, third year would be 25,000, and so on and so on until at the maturity day, we will end with 5 million. Okay? So basically, this is the most complex thing you need for your assignment and your exam when it comes to bonds and comes present value calculation. Of course, there are other aspects, but they are very easy to understand by yourself. The short-term liability, the account payable, the salaries payable, tax payable. These are easy to understand. Any question about this present value calculation and bonds issuance? If you like, what we can do, if we copy quickly all of these and change it with a premium, we won't make a lot of changes, changements, as you can see. Where is it? Oops. What if it was a premium, not a discount? I'm just going to copy all of this and show you the difference. So we will call this scenario 1 as issuance at the discount. Okay. And scenario 2 will be issuance at a premium. And all I have to do is simply to change the effective interest rate to 3%, for example. And when we do this, the calculation will end with an amount of the issue price, which is higher, and then the full amount of the premium now, not a discount. And 133,000. So now the premium is the issuance price minus the par value. So at the day of the issuance, you debit cash for 3,137,000. That is the amount you're going to collect. Credit bonds payable for that amount. And then every year, you debit interest expense, calculate the same way, but this time the bonds payable will be on the debit side, right? Because you're going to have cash always 120 on the credit and a lower amount on the debit. So to balance your journal entry, you have to debit the bonds payable. When we debit the bonds payable, it means it will decrease. It will not increase by so it will this minus this. And of course, on my T account, it should be on the debit side, not on the credit side. And you see what will happen. So progressively, it will decrease until, so again here, bonds payable, debit side, the difference between this and this. And this is how, and when comes, in terms of amortization schedule, so now it is a discount, a premium, not a discount. And I have to change the formula here. The carrying value now is equal to the balance, means the par value, face value, or the future value, plus the unamortized discount, plus the unamortized discount. And then we keep doing this, and we should end with 3 million. It is not the case, so because something has to be updated here. So this 120. Okay, the rate is, we are still using the old rate here. So the rate here should be, the discount rate should be 3% now, not 4%. 3%. Okay, and then okay, something else is the discount amortization. Okay, should be this minus this. Okay, and then so, and as you can see, carrying value will start with an amount which is higher than the par, and then it will decrease progressively. Okay, any question about this? So this is about liability. Let's move quickly to shareholder equity. There are no questions on the shareholder equity on your assignment, but there may be a few questions on the final shareholder equity topic. Let's share those equity. Okay, what is worth to be mentioned about the shareholder equity? So I noticed what you need for your final about shareholder equity. So you will know the difference between common shares versus preferred shares. For example, common shares versus preferred shares. Preferred shares. Okay. First of all, before that, even in terms of presentation, what we used to do now so far when it comes to the balance sheet, when you prepare your statement of financial position, when you prepare the shareholder equity section, we used to do it like this: contributed capital, let's say 3 million. Okay. So far, this is what we do. Now you have to know that is not the right way to do it. You have also, as a requirement, not as an option, you also have to add in your balance sheet, in your statement of financial position, a small description here in the body of the statement, not as a disclosure, not as a note, explaining giving some information. This contributed capital, how many shares? So we have to indicate the number of shares authorized, the number of shares outstanding. Okay, I'm not writing anything. Sorry. Where am I going? I was writing in somewhere. I don't know where. Anyway, so number of shares authorized. What does it mean? According to the chart of the company, how many shares is the board of directors allowed to issue? In some cases, there is a cap, a limit. You cannot exceed that number. So that limit should be indicated here, shown to the users. If any, because sometimes they will put unauthorized shares unlimited, which means there is no limit. They can issue whatever. Outstanding, for example, I am authorized to issue 100,000 shares, but I have only 50,000 outstanding, which means the shares that are traded in the market now that have been issued, not authorized, effectively issued. And number of shares, number of shares, we say outstanding. We also indicate if the shares are issued at par or no par value. Par value or versus no par value. You remember the par value in the bonds? Same thing. But here in the bonds, it is necessary, okay? You need it. The par value, the 3 million as par value is needed. So the $1,000 per bond, the face value or the par value, it has a use. But for shares, it does not have any concrete use. That's why it is optional. A company may issue shares at par value, which means a predetermined value, which is determined by your lawyer or by your accountant, versus the real issuance price, which is determined by the market. So when you issue shares, you can't say this is the share is its par value is $10, and you count, but in the market is willing to pay $9 only, or maybe $11. So usually the market value for the shares is higher than the par value. It means the par value should be established in a way that for sure we will collect more. Okay? Because the difference will be considered as contributed surplus. It will show up if the company issues shares at par, then the excedent, the overpayment above the par amount will go to what we call a contributed surplus, which is a new item on the shareholder equity. So this is now a company may issue either common shares or preferred shares. A common shares will provide 3 rights. 3 rights granted by the common share. And those rights are what? Voting rights. What else? The right to, as an investor, if you hold the common share, what are your rights? What rights are granted by that common share? The right to vote in the General Assembly and the general meeting of the shareholders, and right to what does it mean being a shareholder, holding shares in a company? Of course, one of the rights is that I, as a shareholder, I have the right to vote, depend on number of. What else?
Is it like the right to sell it?
Okay, you're right, but means that is like any asset. So that is a right which is outside this area of expertise. That is a natural right. You have an asset, you can sell it. But the right that are granted by the fact that I hold. So if you sell it, it is no longer a right, right? You have transferred your right. But what are the rights that are associated with the holding the shares? As a shareholder, as long as I hold the share, I have three rights. I have the right to vote in the General Assembly, and I have what? The
Do you
Right
have
to
right to
dividends.
right to
dividends?
dividend, of course. Right to dividend. If the dividend, if the board of directors decide to distribute, to declare dividend, I will have a right on that dividend. And the third one, this one, maybe it is a little bit more difficult. I'm going to say it
Would it
unless,
be
yeah,
the right to sue for wrongful acts?
the right to,
Sue for wrongful acts. I do know some companies have that in their common shares. So is that what you're looking for?
not sure. Can you elaborate on this?
So if the company actually does wrong, shareholders have the right to sue the company directly. I do
The
know
right to
some
sue.
company. Yeah.
Yeah, okay. Yeah, again, that is a general right, federal right. Not only shareholder, or even other can sue the company. Anyone can sue the company if they do wrong. Even me, if I'm not shareholder. I don't know. Maybe they're referring to other thing, but the three fundamental rights granted by a common share is, as we said, the right to vote, the voting right, the right to dividend, and the third one is what we call the residual right.
Is that to do with a company that's wound up or dissolved?
Exactly. When the company is dissolved, then we are going to take the total assets and we are going to convert all assets into cash, and we will have first to pay bondholders, the account payable, govern the tax payable, any payment, any liability first. And if there is something residual remaining, then it will go to the shareholders. That is the residual value. The residual right on the residual value of the company. Okay. Now, as you can see, voting right maybe doesn't worth anything for some people. Small investors, small investor like me who does not have 20% or 10% of the company, they will just have making a few $1,000s of investment just to get some profit. Voting right is nothing for them. So that's why there is an option for a company to issue preferred shares where they're going to take off the voting right, and in consideration, in compensation, they will give you more priority in dividend, which is we call preferred dividend. So preferred shares, yeah, preferred shares will have, so the right to dividend, no, the voting right is taken out. We'll take out the voting right and grant a preferred dividend in compensation. So here, pay careful attention. When we say preferred, it does not make the dividend mandatory for the company. It's still at the discretion of the board of directors to declare or not to declare dividend. But whenever a dividend is declared, they have priority. Preferred shareholders have priority on the dividend declared if it is declared. And now the question is, first of all, any question about this? The difference between common shares, preferred shares. The question is, what happens if for a specific year, specific counting period, no dividend was declared? So if no dividend is declared for the year N, what happens? So here we have two scenarios. Are your dividend cumulative? Preferred dividend, are they cumulative or non-cumulative? At the day you issue preferred dividend, preferred shares, sorry, at the day you issue preferred shares, you have to indicate whether those preferred shares have a cumulative dividend or non-cumulative dividend. So if preferred shares with cumulative dividend, then any non-declared, we start with cumulative, right? Any non-declared dividend is postponed to the next declaration day, and the postponed dividend, we call them the arrears. So if you have 2 years of arrears, it means there are 2 years of dividend, of cumulative dividend that were not declared, and that you will have to pay as soon as the next payment declaration will happen. So and then we say dividend is postponed to the next declaration. Non-declared dividend are called arrears. But if your preferred dividend are non-cumulative, any non-declared preferred dividend is lost, which means no claim on it for the preferred shareholders. Who decided this? The company, the day they issue the dividend. At the day they issue the dividend, it will be described. And as an investor, if you buy preferred shares, you have to pay attention. What kind of preferred shares are these? Look at the description. Are these preferred shares with cumulative dividend or non-cumulative? If it is non-cumulative, so any dividend not declared, forget about it. If they're cumulative, any dividend not declared is simply postponed to the next day, next time. It may be within 2 years, 3 years, 5 years. Next time when the dividend is declared, priority will be given to those arrears first. Priority will be given to arrears. So let's make a simulation. Example. So computation of preferred dividend. Okay. Illustration. So company ABC declared, or first of all, before we say it was declared, have the following capital structure. Say they have, let's say, 200,000 common shares. Okay, and they have, let's say, 60,000 preferred shares. Preferred shares. And now I have to make some explanation. Cumulative. And let's say $1. Okay, or let's put it like this: $1 cumulative preferred dividend. $1, which means every single preferred shares will grant a $1 preferred dividend when it is declared. Okay, $1 cumulative preferred dividend. Okay, so this is in the chart of the company. So this is not something that changes every year. This is the rules. Okay, let me change the format here. And now let's go to the a specific year on, let's say, December 2023, the company has accumulated, let's say, 3 years of arrears. 3 years of arrears. Okay, and at that day, so the board of directors decided to declare, let's say, 60,000, let's say $500, $500,000. Okay. So sorry, these are not dollar, of course. These are numbers. These are numbers, not dollar. Number of common shares. Okay. Oops. 200,000 and this is dollar amount. The dividend declared 500,000. Okay. So the question now, how to distribute, how to break down, how to split that $500,000 between preferred shareholders and common shareholders. So preferred, we start with preferred shares versus common shares. So total amount declared is, as we said, $500,000. Priority will go to whom?
Preferred shares?
What exactly? More accurately.
All of the accumulated dividends.
Arrears first. The oldest arrears first. Okay. So arrears. So they have 3 years. So all right. So 22, 21, and 20. We start with the oldest one. Arrears 2020. And then arrears 2021, and then arrears 2022. And this will go to the preferred shares. Okay, how much is the arrears for 2020? So 60,000 shares multiplied by $1 as per the chart. Okay, or maybe to make it more interesting, let's make it lower than this. Let's make it 130,000. Okay, 130,000. Okay, so we'll first pay arrears of 2020, $60,000. Do we have enough to pay next year next arrears?
Yes.
Yes, we have enough. So we'll go back. We'll go forward. Next year, we also have enough to pay another 60,000. Do we have enough to pay 2022? No, right?
No.
We have already reached the 120. We still only have 10,000. That 10,000 will go to the preferred. This minus this minus this. What is going to go to the shareholders? Total. To the common shareholders?
Nothing.
Nothing. Very good. Nothing. Absolutely nothing. So all the declared amount will go to the preferred shareholders, and 0 will go to the common shareholders. Now, dividend per share. Preferred, they will receive $100,000 divided by 60,000 shares. Each share will receive $2. Maybe not 2.17. Common shares will receive 0. They will receive $0 divided by 200,000 200,000 shares. 0. Now let's copy the full data and change the scenario. Okay, now this is okay for illustration. So we call this scenario 1, and then copy all of these and make scenario 2, where, for example, we have the same data, except that we're going to say that they have declared, let's say, $350,000 as dividend. So what will happen here? We have enough to pay arrears for 2020, arrears for 2021, arrears for 2022, and also the claim for 2023 this year, and we have enough to pay the full amount, right? $240,000. The balance that will go to the common shareholders is the total amount, 350, minus the what went, because the common shareholders do not have priority. So, and they will receive 55 cents per share, the common shareholders, while the preferred shareholders will receive $4 per share. Okay, this is how we do it. So common shareholders authorized contributed capital, preferred dividend, cumulative, non-cumulative, computing dividend. The very last thing you may have is about, so you may be asked about, how about issuing shares to purchase a PPE? Okay, so this is shareholder equity. Issuing shares to purchase PPE. This is a very common practice, and the data for this, they will tell you, for example, on, let's say, August 30, ABC acquired a building by, not by cash, not by on credit, by issuing common shares. And what is particular in this? What is where it is problematic, this situation? The situation is problematic because if it was bought by cash, we will debit building for the what we put on the credit side, the amount of cash received, collected. If it was bought by a long-term liability, as you know, we have to put the present value of what we are going to pay. But this is assurance for common shares. We are never going to pay them back. They are not supposed to be paid back. Okay, so there's no present value, and they may have a listing price on the market which is different. So by issuing common shares, we are going to make this this assumption. So the listed price of, or the fair value, let's say the fair value of the building is equal to 3 million, or let's say 2 million, according to an appraisal of the fair value. Okay, 3 million or 2 million, 2 million, and then our shares, the number of shares of issued, so issued in consideration 200,000 or 20,000. You see what where I go with this. I'm trying to get an amount which is different than that 2 million. How to deal with that? Shares where the market price at that day, when the market price was at that day, the day of the issuance, let's say, so if I make it $10, it will be exactly the same 2 million, right? just to make this multiplied by this. If I make $10, no, $100. If I make it, or let's make it here 200,000, 200. You know what I mean. I need to go to an amount which is slightly different. Okay, and then it was listed at, let's say, $12. Okay, this was the market price. So I have two numbers here. Should I account for the building at 2 million at its fair value, or at 2,400,000 the fair value of the shares? This is the problematic situation accounting. What do you think about this?
Is it the lower value?
No, that is not how it works under IFRS. Under IFRS, you are applying conservatism by doing this, okay? And this is an old accounting principle. By conservatism, I'm going to take the lower price. Okay, now this has been abolished since 2011. Under IFRS, we do not, very good point here. So it allows me to elaborate a little bit. Under IFRS, we do not prioritize conservatism because it is against neutrality. Under IFRS, I have as accountant to be neutral, not conservative. Because if you apply conservatism, it will be against the shareholders, against the interests of the shareholders. Why are we penalizing the shareholders here with that philosophy of conservatism, which is a very legitimate point and very used outside the IFRS world?
So
But under
then,
IFRS, so we do not consider the lowest by conservatism. We consider the most neutral, which is the most fair value. So I have two values. A fair value that is assessed by an appraisal. 2 million is the assessment of an expert subsequent to an appraisal. And I have another fair value which is assessed by the market. So the rule is I take the most reliable fair value. The rule is I have to consider the most reliable fair value. This is the rule. So okay, before we go to the rule, what is the question? What is the problem? The problem is I have to debit equipment, not equipment, building, we said. Debit building, and I have credit common shares, right? For what? 2 million or 2 million for? That is the question, okay? This is the issue. The answer to the issue is this rule. The accounting rule is this. Take the most reliable fair value. I have a fair value, which is the result of an assessment made by an expert, appraisal of the building. That is one evaluation. And then from the other side, I have a value that comes from the market, according to which one is more reliable. Doesn't take all of this time of thinking.
The one from the market?
For sure, always. Whenever the market is questioned, the market is always the most accurate, the best fair value. Always. This is under IFRS, the best assessment of fair value if the market, if there is an active market, if the shares are traded in an active market. Nothing is better than demand and supply. Absolutely no expertise will go better than this. So most reliable. So now if the shares are traded in an active market, then consider the fair value of the shares as what? As cost of the building. If not, We are a private entity. A private entity. We do not have, our shares are not traded in an active market. We simply use the expertise of an expert to make the assessment of the value of our company. In this case, the assessment of a building by a real estate expert is much more reliable than the assessment of a financial analysis of a non-traded company and a private company. So then we consider, if not, then consider the fair value of the building as its cost. Okay. As cost of the building. It's okay. So this is the rule. Whenever there is an issuance for shares, so we have this issue. Should we account the PPE at its own fair value or at the fair value of the shares? The answer to this, which one is more reliable as an assessment? If your shares are traded in a market value, for sure, there is no more reliable in terms of fair value assessment than an active market. Otherwise, then you can rely on the expertise of your real estate appraiser. That's it. This is what you may need for your exam about your shared equity. Okay, now I'm